Hey everyone, I've been drilling into all the new employment data, and there's some good news for commercial real estate investors, and I think there's some headwinds to consider. I'll start with the headwinds. The US economy added just 22,000 jobs in August, and there were some additional revisions to the June and July employment numbers that suggest economic weakening. So year to date through August, the US economy has added about 598,000 new jobs, which is dramatically down from last year. We also had an announcement last week that the preliminary revision to the total number of jobs created between April of 2024 and March of 2025 was significant. That revision will reduce the total jobs added in that time frame from about 1.8 million down to about 850,000 jobs. Now, I should mention that's a preliminary revision and it will be changed a couple of times before the final hard numbers come out in February next year. But all of these indicators are telling us that the US economy is weaker than we thought, and the combination of elevated uncertainty and heightened caution will likely continue to weigh on the employment market. That suggests the risk of a recession within the next year or so may be higher than many believed just a couple months ago. But that brings me to the silver lining for commercial real estate investors. In accordance with half of the Federal Reserve's dual mandate to support job creation, the Federal Reserve will likely cut rates later this week. Some investors are even speculating that the Fed will cut rates by 50 basis points on September 17th. In addition, it's widely believed that the Federal Reserve will reduce the overnight rate by 75 basis points by the end of the year, taking the overnight rate down to about 3.5%. Now, that widely held belief has put downward pressure on the longer-term rates like the 10-year Treasury, which has fallen to about 4%. That is an important milestone. I can't tell you how many investors have told me that 4% is the magic number. With the 10-year Treasury at 4%, a lot more of the properties that are for sale start to make sense to investors. Lower rates will shift more assets into positive leverage territory, and the underwriting starts to work. That in turn suggests deal flow and transactional liquidity could increase as long as the financing costs remain contained. Now, as I've mentioned in previous videos, I encourage investors to take action quickly. Rates are down and lender spreads haven't widened so far. As a result, agency financing on multifamily assets have fallen to the low 5% range, perhaps even nudging below 5% for strong buyers acquiring properties that are squarely within the agency's mission objectives. For commercial properties, lending may be as low as the mid 5% range, again depending on the strength of the borrower and the individual asset. Given the 80 to 130 basis point rise of average cap rates over the last few years, a lot more transactions could finally pencil. However, despite the likelihood that the Federal Reserve will lower rates, the 10-year Treasury, upon which a lot of commercial real estate lending is based, doesn't always move in tandem. As you may recall from last year, when the Fed cut rates by 50 basis points in September, the 10-year Treasury immediately started to rise. Between September and the end of last year, the Fed cut rates by 100 basis points, but the 10-year Treasury increased from about 3.7% to about 4.6%. Nonetheless, as narrow as it could potentially be, we are in a window of opportunity right now where the cost of debt capital could bolster market liquidity. Now, I do want to point out that just because the cost of capital has come down a bit, that doesn't mean that property values will climb and cap rates will fall. What it does mean, however, is that well-priced assets have a higher likelihood of clearing the market. So, as I look beyond the immediate metrics of the employment market and the impact it's having on the interest rate climate, I still see a lot of uncertainty. Federal policies on trade and other issues remain very opaque, so business leader and investor decision-making will likely remain challenging. That makes for a choppy short-term outlook. That said, from a real estate perspective, the long-term outlook remains positive. Commercial real estate development is likely to continue to shrink, which in turn favorably shapes the overall supply and demand outlook. That should bolster long-term occupancy trends across the entire commercial real estate sector. But we are in a very fluid economic cycle, and things can change quickly, which is why investors always need to keep their eyes on the horizon.